Friends, I welcome you all to the current session. So far, we have understood that audit involves expressing an opinion on the financial statement. And this opinion is mostly about whether these financial statements are showing the true and fair view or not. And we have also understood what is the nature of auditing, what is the objective, and what is the scope of auditing. All these things we have understood. And broadly also, we have some basic idea that what kind of report normally an auditor issues. Okay, it may be modified, unmodified, clean report, qualified, disclaimer of opinion, adverse report. These are some possibilities. And when auditor plans for audit, he needs to have a very detailed plan, which we'll be learning. We may refer to it as audit program, where all the aspects of the financial statement needs to be covered. Okay, all the aspects of the financial statement has to be covered. And when auditor express his opinion, he has to also ensure that these financial statements are prepared within financial reporting framework. Of course, it is the responsibility of the management to ensure that the financial statement has been prepared within the financial reporting framework, but auditor has to give an opinion on that. This is because if the financial statements are not prepared within the financial reporting framework, that financial statement is definitely not giving a true and fair view. Okay, the true and fair view concept is important to us. We'll be learning all those things also. Now, having covered the nature, objective, and scope, this is the time to learn various aspects of audit and also auditing assertions. These are again two more concepts we are going to learn. Going to share the screen with you. So current session, our plan is to cover these two things, aspects and assertions of audit. First, let us see. Fourth concept is about the aspects. What are the aspects which needs to be covered in an auditing scenario? Okay. Now you see there is a list of items you can see on your screen. I think you are able to see. These are the aspects which we covered in an audit. First of all, examination of the system of accounting and internal control with regard to appropriateness and proper recording. So before commencement of the audit, auditor is expected to understand what is the accounting system and also what is the internal control system. Okay, accounting system, you know how transactions are recorded, and on the basis of those documents and the books of accounts, financial statements are prepared. That you can report as the accounting system. For example, it may include how transactions are recognized, how vouchers are prepared, how entries are made, maybe how they are summarized, how they're classified, finally how their transactions are converted into financial statement. That is the system of accounting. System of internal control refers to various controls that the organization uses to ensure its smooth running. For example, organization might be insisting a voucher needs to be signed by 2 people, or depending upon the power delegated to different people, these are the people who are supposed to approve a voucher. Okay, so these are the internal control system. Here in an auditing, this aspect has to be covered, that accounting system needs to be examined and internal system also needs to be examined. So auditor has to include in his audit program certain procedures which will be examining the accounting system as well as accounting control system. Okay, auditor may check that actually accounting has happened in that way or not. Suppose vouchers are supposed to be approved. You can see the vouchers. Is there any unapproved voucher? Or let us say vouchers are supposed to be approved within 1 day. If there is any delay, that means there's a weakness in the internal control system. That will indicate that. So through various processes, auditor examines the accounting and internal control system and ensures that they're appropriate. If they're inappropriate, right? Suppose it's a large organization and there is only one person who is preparing the voucher, he's also approving the vouchers. It is inappropriate considering the size of the organization. Inappropriate in the sense that means that person there is a possibility that that person may manipulate the accounts also. because he is writing the voucher, he is also making entry, he is approving. Right. So these possibilities are there. So appropriateness of accounting and internal control, and whether these transactions, account balances are properly recorded, that has to be tested. But this aspect has to be there. Did you understand this? Hope we have understood this. Now, second aspect is that review of system and procedures. For every transaction, there must be a system. Suppose something has to be purchased. There might be some regular purchase, there might be some exceptional items, there might be some capital items, there might be some projects related to projects, some purchases might be related to projects. So what is the system or what is the procedure followed by the entity to account for all this? Are they adequate? Or is there any weakness in that system? That is also included in the aspects of audit. The auditor has to review that system, review the procedure, and check whether the system and procedures are adequate, or if there is some weakness, the auditor has to see the effect of that weakness on the truth and fairness of the finance system. Because of that weakness, there might be some mistake, there might be some errors, there might be some frauds, or this weakness may lead to some error and fraud, which will affect the truth and fairness of the finance system. Auditor needs to consider that. Okay, right. Third thing which needs to be covered as an aspect of auditing is checking up arithmetical accuracy. Nowadays, you see most of the transactions are generated through computer. Computations are also made through computer. So the possibility of arithmetical mistake is remote, but still there are possibilities. There are possibilities of inaccuracies. And that also needs to check. Auditor needs to check those control figures, those master data figures, that if they are fed properly or not in the system. Otherwise, calculations may go wrong. Suppose depreciation rate is wrongly fed. Then naturally, computer system will calculate by using the wrong rate. Suppose interest rate is wrongly fed to the system. So that may lead to arithmetical inaccuracies also. Computation mistakes might be there. So that is also one part of the aspects which to be covered in an audit. Fourth thing which needs to be covered is verification of authenticity and validity of transactions. Here, transactions means the financial transactions we are referring to. Are they authentic? Are they genuine transactions? That means actually that thing has happened or not. Suppose purchase of stationery. Actually, things are purchased or not. You may think how to know that authenticity. You may refer the bill. You may refer the invoice. We are saying bills are there. But is it the evidence that actually it has been purchased? So you may ask for bills. If some stationery is purchased, there might be some goods received note, but stationery are entered through gate. GRN must have been prepared. You can cross-check that. Okay, it might have registered in the store's register, stock register. You may check that. So through that thing, you can get some idea that the transactions are authenticity or not, and whether the transactions are valid transactions or not. Okay, whether they're approved. The transaction pertains to the business, that's a business transaction. It's not somebody's personal transaction. And it is also falling within the accounting period. By verifying all these things, we'll be able to ensure that whether the transaction is authentic and valid. Okay. Then one more thing is that auditor needs to ascertain the distinction between revenue items and capital items. Some items are of revenue nature. Regularly, this income. Okay, they are like expenses or incomes. Some items are of capital nature. That means they are not, in fact, regularly purchased, but they affect the assets and liability positions of the entity. Okay, they may not be incomes, they may not be expenses, but they're assets and liabilities. Okay, suppose for example, if furniture, suppose furniture is purchased from an office, that's a capital item. Unless you are a furniture dealer, the furniture dealer, you are selling furniture, for you that's a revenue item, it's a trade purchase. You are selling furniture, that is a trade sales. But you are not a furniture dealer, you have some other office and you are purchasing furniture. So that's a capital item. Is it not? Let's say you are purchasing a vehicle, that's a capital item. It is going to affect your assets or liabilities. You have taken a term loan for vehicle, that is going to affect your liabilities. But if you are a vehicle dealer, then you are purchasing vehicle, selling vehicle, that is your revenue. So this is again one of the aspects which needs to be covered in the audit, that whether items are properly classified as revenue items or capital items. Capital items should hit your balance sheet, and revenue items are going to hit your statement of profit and loss. Is it clear to you? Yes or no? Are you getting me? Please unmute and speak. Now, next thing is comparing balance sheet and profit and loss with other statements. You see, other statements may be some financial data, maybe with some non-financial data. With some non-financial data also, things can be compared. Suppose profit and loss accounts, let's say employee benefit expenditure or salary expenses. You can compare it with salary statement. You can compare it with the bank account. These are financial things. You may also compare it to the attendance register, which is a non-accounting, non-financial record. Okay, so like this, the profit and loss statements can also be compared with different items. Okay, through this comparison, or through making this kind of reconciliation, you may collect audit evidence. You may get some idea that whether the transaction is authentic, valid, accurate or not. Okay, suppose sales transaction. You may compare it with your sale bills, which are internally generated because you yourself is generating sale. Okay, you can compare it, let us say, something like GST returns. Okay, like this kind of comparisons are necessary. Okay, so comparing the balance sheet and profit and loss with other statements. This also includes the balance sheet and profit, comparing the balance sheet items with these detailed notes. Okay, and or with the trial balance, or with some analytical records. The next aspect is that verification of title and existence of assets. That's also important. Okay, you need to verify the title as well as existence. How will you be able to verify existence? You have to think what is the proper method. Suppose you are saying in the balance sheet of an entity, that's a vehicle. Now, please tell me, how will ensure that vehicle exists? Can anyone tell me? What kind of test you will do to see that vehicle is existing? Can anyone tell me quickly? You want to verify the existence of an asset, vehicle.
Sir, ask them to produce the fuel bills.
Okay, ask them to produce fuel bills. Okay, that is again, that will give you some kind of evidence. Any
Sir,
better?
and the toll gates check-ins.
Okay, that also you will get some idea that vehicle is actually moving. Then what else? Some other ways. So all this, you can say procedures you can apply, you can adapt all these things. Then what else you can do? So you can fuel bills. You can ask if vehicle is going outside. You can check the, let us say, toll gate bills. Okay, you can also, if you ask, you can go for the physical verification also, if it is possible. If your vehicle is in that area, you can go for physical verification also. Okay, normally you should see the, you should attempt for physical verification. If for some reason it is not possible, then you may collect some other evidences. Is it not? So all these things will satisfy that vehicle is an existence. But how will be able to verify the title? That means vehicle is there, but actually the vehicle belongs to this entity or not. If it is a company, whether it's a company's vehicle or it is in somebody else's name. How you will ensure the title?
So by seeing the registration
Registration
papers.
number.
Okay, you can see the registration number, registration certificate. Okay, you will ask for the RC. Yes or no? Okay. Right. You can ask for the RC. And if physically you are verifying, you can also cross check. You can go, you can physically check the vehicle. You can take the RC. You can tell the client or tell the entity to show that exactly the registration number, engine number, chassis number, all these things are matching, which is there in the RC. You can do that. Okay. You can also cross check that if you want, if you have some doubt about authenticity of that RC book, then you can also, other mechanisms are available. Let us say that that link is there, no ID bahan.com or something. Therefrom you can check that whether actually who is the owner of this vehicle, you can check. Okay, and there is, there's a number. If you SMS the vehicle number, you will get the owner's detail. So you can get it confirmed. Sometimes you may ask for confirmation from RQ. Okay, so these are various ways through which you'll be ensuring the title. Is it not? And again, let us say in the title you are finding there's a lien. Lien means the vehicle might be hypothecated or might be placed for some loan. That must be there in the RC book. Is it not? Is it not? If it is there, whether that lien is disclosed in the financial statement. The financial statement, it is showing that vehicle is there. Vehicle. But nowhere it is disclosed that vehicle is hypothecated to a bank. Because there is a loan outstanding and vehicle is offered as a security. But that data you can get in the RC book also. Are you getting? So that needs to be reflected in the financial statement. That disclosure should be there. If the entity has not disclosed, that means disclosure is inadequate. Are you getting? Now, just like you are supposed to verify the assets, you are also supposed to verify the liabilities. Suppose there is a loan in the financial statement. You are expected to collect the loan statement or get the confirmation from the lenders that is the loan amount. You have to ensure there is no interest is outstanding. What is the exact amount of liability you request? You have to also ensure that no liabilities has remained unreported. All the liabilities should have been reported in the financial statement. So liability verification is one more aspect which needs to be covered in our. Then checking of results of profit and loss statement. So when you arrive at the, when the client or the entity arrives at the profit or loss figure, how they arrive at? They recognize the revenue, they recognize all expenses. Finally, they get the profit figure, that is profit before tax. Then they do some adjustment for taxes and they find out profit after tax. Is it not? This is how statement of profit and loss account is prepared. But here one has to see that the way revenues are recognized, that is right or wrong. Or the way expenses are also recognized, the expenses are booked, whether that is acceptable or not. Right. When these revenues are recognized or expenses are booked, The entity uses various estimations, various assumptions. And there are many areas where judgments are also involved. So on the basis of these estimations, assumptions, and judgments, the financial statements are prepared, and it is giving a result, which is a profit or loss. Here, the challenge is to ensure that whether these assumptions, estimations, judgments are acceptable. If it is acceptable, then the financial statement may be given to a fair view. If something which is not acceptable, suppose management's judgment is that there will be no bad debt, and you feel by looking at the history there will be some kind of bad debt. That means judgment is not acceptable. So financial statement may not be given to a fair view in that situation. Then next aspect which is to be covered is confirming the statutory requirements. So an entity has to comply with a lot of statutory requirements. It has to follow various laws, rules, and regulations. Normally, in an entity, when an auditor starts auditing, he asks the management to give the list of the laws which they are supposed to follow, because it also may not be possible for auditor to keep in track of all rules and regulations which one is supposed to follow. Okay, so auditor needs to prepare a list or ask the management that which are the laws and regulations which are supposed to follow. And auditor also should confirm that all the statutory requirements are complied with. Okay, if they are not complied with, it may affect the assets liability position. It may also affect sometimes the continuity of the organization. And that means it may affect the fundamental accounting assumption of going concern. Meaning, because of this non-compliance of the rules and regulations, that going concern assumptions may not be continued, may not be appropriate in that situation. Accordingly, since financial statements are prepared, taking that assumption, financial statement may not be showing true and fair. Are you getting me? Yes or no? For example, suppose a mining company needs to have a mining license. And if you feel that mining license requirements are not complied with, and you also feel that this entity may not be able to comply it at all. So because of that thing, you feel since that license will not be there, the organization may not be continue as a going concern. You feel in near future that the organization has to liquidate. Then the financial statement has to be prepared in such a way that going concern assumptions are not valid. Because in that situation, going concern assumptions are not valid. Okay. So these aspects has to be taken care of. So confirming the statutory requirements is one important. Finally, auditor has to report to the appropriate person or body. Here we are talking about the statutory audit. So normally auditor reports to the appointing authority. In case of company, it reports to the shareholder. And in case of some specific entities, like some public sector banks, etc., that Banking Regulation Act or the act through which they are controlled suggests to report to some other authority, some other person. For example, if you see the audit report of a public sector bank, you will find it is addressed to the President of India. But for a normal company's audit report, if you see it is addressed, you'll be definitely see must have been addressed to the shareholders. So it depends. So reporting should be to the appropriate person and to appropriate body. So friends, these are the, you see, 11 points we covered as regards to aspects to be covered in an audit. But here you have understood that auditing is not necessarily, you have to see that it's not limited to the arithmetical accuracy. Meaning it's not that you'll be only checking the figures. You are supposed to evaluate the internal control system. You're supposed to evaluate the accounting system. You are supposed to evaluate the authenticity and validity of the transaction. You're also supposed to ensure that the distinction between revenue items and capital items are perfect. Title of assets are okay. Assets are actually existing. Liabilities are properly valued. Financial statements are giving true and fair view. Statutory requirements are complied with. Right, all these things are covered. Okay, these financial statements are also supposed to be prepared in the form in which it is accepted. Form of reporting is also important. Right. So for a company, if you know the Schedule 3 of the Companies Act suggests the format. There are different formats or different divisions are there to the Schedule 3. For example, if the company is complying with Ind AS, he might prepare a financial statement in a different format. Some other companies may prepare the financial statement in a totally different format. A banking company may prepare the financial statement in a different format. A power generation company may be preparing in a different way. So the form is also important. All these things has to be covered. All these aspects has to be covered in the audit. Okay, you may have a look at this picture. This will again throw you some light about the aspects to be covered in an audit. All these things has to be covered. Just have a look for a moment. Well, friends. So friends, now we have covered, we know what is the nature, what is the objective, what is the scope of audit, and what are the aspects to be covered in an audit. All these are fundamental things. And we need to understand each of these concepts. Now, this concept which you are going to learn now, the fifth important concept is the assertions. Okay, this talk might be new to most of you. Let us understand what is this concept I am going to cover. Now, assertions. First, let's understand what are the assertions. So, if you read this slide right now, it refers to representations made by management. Friends, at this stage you understand. Or you tell me now, who is preparing the financial statement? Who prepares the financial statement?
Management of the
So the organization.
Organization's management, right? They prepare the financial statement. Now it is whose responsibility to ensure that the financial statements are prepared in a way that it gives a true and fair view. Whose responsibility is that?
And the board of directors.
Or management, you can say. Okay, the board of directors are those charged with governance or the management. Management is responsible that the financial statement is prepared in such a way that it gives true and fair. And again, you tell me, it is whose responsibility to ensure that the financial statements are prepared within financial reporting framework. We know what is that financial reporting framework. Who is responsible? Can you reply? Friends, again, it is the responsibility of the management. Right. So management is responsible for all these things. Auditor's responsibility is to do an attest function. That means that is manager will prepare, auditor is attesting that financial statement. He has to give a report whether, in his opinion, this financial statements are showing to a fair view or not. Okay, auditor is not preparing, auditor is attesting. He gives a report. Right. So when management prepares the management, it directly or indirectly makes certain representations. These representations are called as assertions. Are you getting some basic idea? So that means assertions refer to representations by management, explicit or otherwise. Okay, this representation may be expressed or may be implied also, which is not explicit, we can say it is implied. Okay, so these assertions or representations are made by management, and these are in fact embodied in the financial statements. Okay, that means it is already there in the financial statement. They are embodied in the financial statements as used by the auditor to consider the different types of potential misstatements that may occur. So management makes those representations. They're embodied in the financial statements, and they are considered by the auditor to find out the possibility of misstatements. Okay, that is what it is. These things are called as assertions. The representations which are made directly or indirectly or explicitly or otherwise are the assertions, and they're used by the auditor to consider different types of potential mistakes. Now you may be thinking that what are these representations made by management directly, indirectly? Okay, for example, now just before few minutes we're talking about how we are going to check or verify that existence and existence of the vehicle. Okay, right, existence and ownership of the vehicle. That means when the management is preparing the financial statement where he has included the term vehicle, so management is definitely claiming that the vehicle is the entity's vehicle. Yes or no? Or you can say management is explicitly or otherwise giving a representation that it is their vehicle. Okay. And it's also giving a representation that the vehicle is in existence. Okay. They're also giving a declaration that or representation that vehicle is in existence and vehicle is that means the owner of the vehicle is the entity. And this is used for the purpose of business. So like this, various representation management gives explicitly or otherwise. Now what auditor does, auditor considers, is there any mistake? Is there any possibility that this particular vehicle is not belonging to the company, to the entity? So there is a potential of such mistakes. Many times practically we have seen. Okay, we have seen that many cases, vehicles registrations, you find company name is something, but vehicle is registered some other. Okay, suppose company name is something. You can see the company's incorporation certificate name is something, but vehicle is registered in an, let us say, abbreviation. Okay, suppose State Bank of India, but vehicle is registered with the name of SBI. So that is a problem. Is it not? Sometimes we have seen in the fixed deposits, there are also assets. Practically, we have seen. So, company name is something, but fixed deposits are purchased in some other. Okay, most of the cases, let us say, in the name, not exactly the name, in some abbreviations. Okay. Suppose company name is just an example. It's a National Aluminium Company Limited, but it is purchased in the name of NALCO. NALCO is not the name of the company. Or Steel Authority of India Limited, but assets are purchased in the name of SAIL. So these are potential mistakes. Are you agreeing with it or not? This kind of potential misstatements are there. So auditors first see is that what is the representation management is making, explicitly or otherwise. And these representations are already embodied in the financial statement. An auditor now uses that to consider the different types of potential misstatements that may occur and that occurs. Practically, we see many cases that occurs. Misstatements are there. Okay, now let us elaborate. Let us understand what are these assertions we are talking about. So basically, we got our understanding is that these are representations. Yes or no? Who makes this representation? Who makes those representations? Who can tell me? Management makes that representation. Management may make it explicitly or otherwise also. Right? Now, what auditor uses this assertions? What are the use of these assertions? Now, please let us this paragraph. In representing the financial statement in accordance with the financial reporting framework. Financial statements have to be represented in accordance with the financial reporting framework. Now, while doing so, the management either implicitly or explicitly makes assertion regarding the recognition, measurement, presentation, and disclosures of various elements of financial statement. Okay, so implicitly or explicitly, management makes assertions or management makes representation about how that item is recognized, how that is measured, how they are presented, and what they are disclosed, and what are the things that are disclosed, and what are things disclosed in the financial statements. Right? So management makes representation as regards to recognition, measurement, presentation, and disclosure. Okay, suppose management is recognizing revenue. That means you have to understand that it is recognizing within the financial reporting framework in accordance with the AS which is applicable to revenue recognition. That means revenue recognition, because that is according to financial reporting framework. Management is giving you that representation and also giving you representation that the value, which is the measurement aspect, that is also correct. Presentation aspect is also correct. The way it has to be presented, it is presented. Okay, suppose it is a current asset, it is presented in the current asset in the balance sheet. If it is a non-current asset, it is presented under non-current asset under the balance sheet, under the non-current asset head of the balance sheet. And if some disclosure is required, suppose cash and cash equivalent, one has to disclose what is the components of the cash and cash equivalents that are also disclosed. So management makes representation that all these things are taken care of. Okay. Now, if you try to understand that what is the use of these assertions again for the auditor, because now management has made this representation. Auditor needs to ensure what are the different types of potential misstatements that may occur. So what auditor does, or for the understanding of the auditor classifies this assertion into three categories. Okay, you see these assertions which are made by the management. Let us classify into three categories. First one is, can you read it here? Assertions about this yellow box.
Transactions or events.
Assertions about transactions or events. For financial transactions or financial events, events are also transactions. Some assertions are made. Secondly, assertions about
Account balances.
Account balances. So you can say this part, assertions about transactions and events, relates to the statement of profit and loss. And the account balances assertions, they relate to the balance sheet. And there is one more group of assertions, they relate to both. What are these? Presentations and disclosures. Okay, presentations and disclosures. So these are various types of assertions. Now let us have a look at what are the assertions under each of them. Under transactions and events, you can see there are 5 types of assertions. Can you read it out? Under transactions and events.
Occurrence,
Okay,
completeness, accuracy, cutoff, classification.
okay. That means management is representing that transaction has actually occurred. And transaction is complete. That means what is to be accounted is to be fully accounted. Suppose sales has been made for 10 lakh rupees, 10 lakh rupees has been accounted, not that 8 lakh rupees has been accounted. No. Transaction is complete. And accuracy. Amount is also correct. Cutoff means we are talking about the period. The transactions happened within that accounting period, within the reporting period for which these financial statements are prepared. And they are classified properly. If it is operating revenue, it is prepared as it is coming under operating revenue. Right? Understood? Then assertions about balances. You see, there are 4 types of assertions. Can you read it out?
The first one is existence.
Right.
Second, rights and obligations, completeness, valuation and allocation.
Right. That means management, when showing something in the balance sheet, that's account balances. Management giving you a representation that the assets exists or liability exists. So auditor needs to find out what is the potential of misstatement. There may not be asset. Auditor need to check that. There may not be liabilities. So existence has to be verified. Auditor may consider potential misstatement in that area of existence. An auditor has to see that assets we are talking about are in fact rights of an entity. And if you are talking about liability, they are in fact the obligation of the entity. If you are saying in the books there is an asset, but you don't have any right to use that, that is not your asset. Is it not? That is not your asset. Your asset in the books it is showing it is asset, but you don't have any right. There is potential misstatements or not. Right? You must have seen in the cities when you move, many times you see police vehicles are donated by some company. Some companies might have, as a part of their CSR activity, might have donated vehicles to the police department. You might have seen. Have you seen it or not? You must have also seen the traffic lights. Some places you have seen they are sponsored by some companies. So company is the owner, but whether the company has the right on that, can the company use it? Can the company take it back? Answer is no. Company has already handed over to some other department, maybe to police department, maybe to municipality. The rights are not there. So in that case, if those assets are booked as assets, then it is a wrong thing. So this is again the possibility of potential mistakes. So auditor sees that actually assets are liabilities, assets are rights, and liabilities are obligations. Entity is supposed to pay, therefore it is obligation. Auditor will also has to see that these account balances are complete. Nothing is missed out. Lastly, under this account balances, the valuations are proper. And if there is joint asset or something that is properly allocated to different departments or different entities. Suppose there is a house, there is joint owner that has been properly allocated, which each person's share is properly recognized. And there are again 4 assumptions under presentations and disclosures. Can you read it out?
Occurrence, right and obligation, completeness, classification and understandability, accuracy and valuation.
Here, auditor consider the potential misstatements of occurrence. The presentations and disclosures which has been made, actually that has been occurred. And if it is related to some balance sheet items, then assets are rights and obligations are liabilities are actually obligations. And the presentation is complete, and it is properly classified, and it's understandable. Okay, accuracy aspects are taken care of, and the value which is included in presentation disclosures, that is also correct. Okay, so auditor considers the potential misstatements in these areas. Okay, so this is about the list of assertions, but each of these things will be again discussed in our next session. So today I gave you a broad idea about various assertions. Hope you have understood it. At a basic level, you got a complete idea, but in detail, again, we'll be discussing in our next session. Okay, is it clear to you?
Yes, sir.
Okay, friends. Thank you very, very much. We'll end off this current session right now. We'll catch up in our next session. Thanks a lot.